So welcome to the start of the course. So listen, this video is going to go over an introduction to Forex trading. And I want you to know that even if you have Forex experience, I still want you to watch this whole video. I just want you to sit through it and watch it all, because it's going to help you frame your perspective a little bit better, most likely. And it's going to also show you the importance of knowing what Forex is, because it allows for the right context and an understanding of the market you're literally going to be trading, and also why you're trading it. So to give a little bit of context, if you were to look at a chart like this, and I were to just show you this screen and start teaching you, hey, you want to look for this and this, you want to look at all these lines, you look at these candlesticks, and you want to buy right here, and then you target and stop loss, and all this crazy stuff. You're seeing all this technical stuff that's really trivial in the grand scheme of things if you don't understand the basis for what you're actually doing and the logic behind it. And so that's what I want to start this course off with, is I want to just introduce you to what Forex is, and also probably a little bit more importantly, what a market is, because Forex is just essentially a financial market within thousands, millions of markets that exist here on Earth. And to understand how to trade Forex, or anything for that matter, you have to understand how markets work. And so I'm going to be going through an overview of three main things. The first thing I'm going to start with is, before learning what Forex is, you got to understand what market is. So we're going to be going over what is a market. We're also going to be going over what is Forex trading. And we're also going to be going over why should you trade Forex. Okay. So like I said, even if you already know what Forex is, just like sit back, pop a LaCroix, and watch this video. So let's get into it. What is a market? So pretty much what it boils down to is a market, in its simplest form, it's a place where people meet to buy and sell things, products, services, and also digital things such as assets within financial markets, such as online educational courses, kind of like here at Mission Effects. There's a bunch of different financial markets you can trade. You can trade stocks, currencies, metals, indices. And so, for example, the stock market is a place where people meet, digitally of course, to buy and sell stocks. And that would just be what the stock market is. But if we're looking at just a market in general, let's just say that this 10-year-old drawing of a circle right here is a market. And people come from over here. They enter this market right here to buy things. And people from over here enter the market to come in and sell things. And you need a buyer and a seller for a market to work. You need an exchange. So as you can see, this is BS right here. That's what a market is. A market is BS. So anyway, that being said, a market is a place where people meet to exchange goods and services, and also a stock. So for instance, if you're trading the stock market, which is this right here, and you're jumping in here as a buyer, you're wanting to buy stocks, right? Well, you can't buy stocks from out of thin air. There has to be someone or an entity like a corporation or a business or a broker holding those stocks that can then sell you those stocks. And then you would buy those stocks and you would obtain those stocks, and you've now purchased your good or product, which in this market right here, the product is a stock. You're buying a share of a company. Okay. So another example of a market is, let's say that you want to get into luxury watches. You want to get into stuff like Rolex, Audemars Piguet, Patek Philippe, all these luxury watch brands. So you look at the watch market and you see that there's like this special watch. And like I said, please excuse my my 10-year-old drawing right here on this watch. But let's say there's a market for a nice Rolex watch, which looks a ton better than this one right here. And there's a little Rolex crest thing, and then it's a really cool watch. So you want this watch right here, and you've looked at the market price of this watch, and the market price of this watch is, let's just say it's like $10,000. Okay. So since the price of this is $10,000, that must mean that there is two sides of this. There's supply and demand. On one side, there's a supply of these watches. Now there can be like 1,000 watches. There can be 10,000 of them made. There can be 20,000, maybe 50,000. There can be whatever. There's just a certain number of supply. And there's also a demand on the other side of things. Whereas the demand, let's say there's only 1,000 of these watches ever made, and the watch, as the market price is around $10,000. If there's 2,000 people wanting to purchase these watches, Well, guess what? Not everyone's going to get one because there's only 1,000. So that means that there's higher demand than there is supply. And so if the market price was $10,000 right here, and there's 2,000 people that want to buy these watches versus only 1,000 that was ever made, well, all of a sudden, if 1,000 more people come into the picture and now there's like 3,000 people who want to buy these watches, the price, what's typically going to happen is the price is going to go up. Let's say, in this case to around, let's just say 13K. In all markets, whenever the demand of something goes up and the supply stays the same, or even worse, the supply decreases, when the demand goes up, the price goes up. And typically in a lot of markets, when the supply shrinks, that will mean that there's less supply. But if there's the same demand or even more, then the price is still going to go up. And quite the contrary, let's say that Rolex mass produced this watch right here, which they don't do, but let's just use this for an example. And let's say that there's like $10,000 of these Rolex watches produced. But let's say there's only really a market of 100 people who want to buy them. So there's only 100 people, there's only the demand of 100 people wanting to buy these watches, but Rolex for some reason made 10,000 freaking watches. And so since only 100 people want to buy, only 100 people are going to buy these watches, meaning that there's going to be like only 9,900 left. And so the fact that there's 9,900 left, there's going to be a huge supply, which is 9,900 watches, but the demand is zero. Nobody wants to buy them at this price right here, which in this example, let's just say it's like 10K. There's no demand for that price for that many watches. So what happens when there's a huge supply of something, but no demand, the price of something will typically go down substantially. So in this case, maybe there's 0 people who would buy one of these watches at $10,000. Rolex may have to do some wild stuff, like cutting the price of this watch down to like $1,000, so like 1K. And then let's say at 1K, let's say for $1,000 price point, let's say all of a sudden there's 2,000 people that would totally buy one of these watches at 1K. So there's 2,000 people that would buy it at 1K, and then that slashes the supply down to like 7,900. But then at 7,900 watches, they still have to sell, and the price is 1K, and there's no longer any more demand. There's now 0 people who want to buy the watch at $1,000. The supply is still high, but there's no demand. No one wants to buy it. Thus, the price will typically go lower. So imagine like now they were selling it for or they had 7,900 watches. Now, let's say they have to slash the price down to something insane like $200, and then maybe a couple thousand people will more buy it. But do you see what happens here? When the supply of something is higher than the demand, the price will typically be low, or the price will begin to decline. When the demand of something is very high, but the supply is low, it makes it a little bit more rare, and for whatever reason, people will want to buy things, and people will pay more for things where there's a very limited supply. And these are the laws of supply and demand. So if I were to look at this on a chart right here, let's just say this is a chart with Rolex watches. And we'll say right here is the price in dollars of the watches. And right here we'll say this is the value of the watches from starting in, let's just say 2013 all the way to when you're watching this, which, I don't know when you're watching this, but it's 2019 right now, but let's just say 2020. So from 2013 to 2020, it's about, 7 years of price data. Let's say you were able to buy a Rolex Submariner right here in 2013 at around, I don't know what they were back then, let's just say like $5,000. You bought it for $5K. If I'm madly off, then it's all good. Well, a certain number of these watches are only going to be made in that exact reference number for that year. And let's just say, Rolex sent, let's say 100 of them to authorized dealers, and each authorized dealer only got like 100 of these watches, and they all sold out, the first couple days, and there's only a limited supply. Well, you know what? As time goes on, the value of these watches is typically going to go up because there's only one watch from 2013. And as time goes on, there's going to be more people wanting that watch, more people entering the marketplace that want to get that exact same watch, especially if they did something weird, like making it like a special dial, or it was made with a special metal, or it had a certain engraving or someone signed it or something crazy like that. If there's like a limited quantity and it was something super special, what's going to happen is as time progresses, the value of the watch may go up to like, 10K within a few years. Let's just say, this right here. This is 10K. So price gets to 10K. And then let's say it like stays around 10K and it falls around for a bit because there's not really any change in the supply or demand. But then all of a sudden, let's say that Rolex, let's say 2013 through, what's this right here? We'll say this is like 2018. So 2013 through 2018, let's say they made it with a certain type of steel, but then they end up discontinuing this type of steel. And it was like a really special type of steel. And they start transitioning into a different material to make it, or the band has something weird, like it's no longer polished steel, it's like brushed steel or something weird like that. Let's just say they change it, and Rolex announces, never again will we make the exact one we made in 2013 with that same steel. Never again. That's it. Done. It's all going to be new from here on out. The people who wanted that right there and that steel, they know, oh wow, there's only a limited supply of those, and now they're not even going to be making it anymore. So now I can't buy a Rolex watch new in 2018 or 2019 with that exact same material. And so what happens? There's only a limited supply, but now all of a sudden the demand has increased because people want it, because it was discontinued or whatever. So now as the demand goes up, the price will start going up more. And why? It's because people are willing to pay more. They're willing to pay 11K, 12K, $13,000 for this watch, and the price will just keep going up in here until it finds stability in the market. Maybe it gets to 15,000, by 2020. I don't think this is what Submariners did historically, but it did something like this. If you hold on to your Rolex for maybe like a decade or two, it's at least going to double, triple in value. You're going to be able to get more for it because this is historically what Rolex has done. They don't mass produce watches. They just make them in like limited sets and stuff, and they do that so that this happens to the market. So the laws of supply and demand state, in essence, when the demand is high for something, the price will typically go up. And when the supply is bigger than the demand, the price will typically go down until the balance between buyers and sellers is at equilibrium, at which point price won't really change much. If there's no like high demand and there's not really that high of a supply and everything just kind of stays the same, price typically won't change much. It'll just kind of like people will buy and sell them and trade them around this price. But as the demand goes up for something crazy, then price will go up. So supply and demand. That's what supply and demand is. And that's all you need to know about it. So let's transition to the next thing that we're going to talk about right here, which is whenever we look at markets, they're all a little bit different, but if you're looking at supply and demand, they all work roughly the same. Meaning as the demand goes up or something happens, the price will go up. And then as the demand falls or people get scared and they don't want to buy something anymore, the price will start going lower and lower until people will want to buy it at a certain price. And so like any market, you want to buy something whenever it's low priced. So that way you're not overpaying for it. And whenever you're a seller and you want to sell something, you want to sell it at as high a price as possible. Because when you're selling, if you care about value and you care about getting the maximum value in monetary terms for whatever product or service you have, you want to sell it at a good price, and a good price is typically a high price. So whenever you're in a market, let's say you were in the Rolex market and you can get a Rolex for like 10K at market price. But then all of a sudden someone comes along and says, hey, I have that same Rolex that's trading right now for 10K. I could sell it on the market to somebody and I could wait like a week or two to get it sold at 10K. Or I could sell it to you right now for 8K. And then you could then go to the market and you could post it on eBay or Amazon or, wherever, like Chrono24, wherever people sell watches. You can sell it for 10K. You probably have to wait like a week or two to get it sold, but I need the money right now. So I'm willing to sell it to you for $8,000 cash, like literally right now. Let's go to the bank and I'll let you get the cash and I'll sell you this watch that's worth 10K. I'll sell it to you for 8 right now. And that they're like, oh shit, if I just go and I, get the cash to buy this guy's watch for $8,000, assuming it's a real Rolex and all that crap, like you can immediately just go post it on eBay, keep it up there for like a week or two, or however long it takes to sell, and you can sell it for around 10K. And what's even crazier is you can buy it at $8,000, and let's say you just hold on to it for another few years. The market price is probably going to go up because there's only a limited supply for a very certain specific Rolex. And if you hold on to it for a few years, let's say 2-3 years from now, you could probably sell it for like 12K. And during that whole time, you've gotten to enjoy, a fine timepiece, a Rolex watch, or whatever, Patek Philippe, Audemars Piguet, whatever you like. And so buying at a low price seems so logical, and people love buying at low prices, especially when they know the value of something is more, whenever they're getting enough value that justifies the price. Now, this is the same, let's say in the market for, let's use a very direct example. So you purchased my program, right? And whatever you paid for my program, you saw that the value in the program that you're in right now was worth more than the amount that you're paying for it. Otherwise, you just wouldn't have bought it. If you didn't think it was worth it, then you just would not have bought the program, right? And so whenever there's a product that's so good or so enticing or so nice that people want it so bad that they will look at the price of something and they will say, you know what? Even if I think it's high price or even if I think it's this and that, if I'm a buyer and I'm wanting to get something of quality and I think that the quality of that product is going to outweigh the price that I'm going to pay for it, people are going to buy it. It's a no-brainer. And so maybe that was you whenever you came into Mission FX and you watched the free trading and now you're in the program and you're all excited and stuff. Whatever it was, you made a few decisions and you went to a few different things and you collected all this data and information about the thing that you purchased, if you're smart. And you collected all this information, you made a decision. You're like, okay, is this going to be worth it? Is it worth the price? Am I going to be getting enough? Can I justify the price? Yes, if that's the case, then a person will buy. And this isn't just with, Forex trading. This isn't just with like online products. This is with anything in the world. Anything in the world. If you can justify the price of something, it's worth it to buy. Same thing for selling. From the seller's point of view, let's say you were someone, selling razor blades. And you're like that Dollar Shave Club guy who built up his huge company, and you can source those blades from China for like 25 cents a set, and you can sell it for roughly like $3 a pop and ship it to people in the United States, and you can make a profit of 2x to 3x of what you paid for it, or even more for like the other sets. You can sell that at a price that's worth it to you, and you believe, okay, if I sell it at this price, it's probably going to be, it'll be good because I'll at least get my money back and maybe even make a profit. So that logic between buyers and sellers is very important because that is literally what drives price. That in its purest, simplest form is what drives price. That desire to buy something and the desire to sell something. So let me give you another example of this as we transition into the last portion of what markets are. The idea in any market, especially if you're trying to make a profit, which is what you're trying to do in Forex, is you're trying to buy when you believe price is going to go up, and you're trying to sell when you believe price is going to go down. And I also want to highlight something else, and it's that no one, and I mean no one, will ever know for a fact what price will do. And so you have to have a way to control risk. Okay? So let me give you an example. Let's say, just since we've been using Rolex this whole time, let's say the price of Rolex is doing this. It's floating around $5,000 for this watch. Price goes up to around $6,000, then $7,000. And then all of a sudden, price goes sideways for a while. And this is like for maybe a year. And then price starts dropping. And then price starts dropping even more. And then it quickly drops from like $5,000 into the next day it dropped to like $4,000. And you look at this and you're like, wow, this watch used to be, new. Let's say it was like, $3,000, and then it went up to $4,000, and then it went up to like $5,000, and now it's back at $4,000. If you're looking at long term, you know that long term, having a Rolex watch is probably a safe bet, especially if it's like a sport model or whatever specific one is. And so you look at this $4,000 price and you think that is a steal. And so let's say you buy right there. You bought at that price because you think it was low and you anticipate that price is going to go up. So then, after you buy, let's say price goes down to like $3,800, then it starts going back above the $4,000 mark. Then it comes back around here, and I want to show you something. Let's just say that price is $5,000. When price comes back to where it just was at $5,000, and let's say this happens over the course of a year or two, previous prices set what is likely to happen in the future. So let's say a price of your watch that you bought at $4,000, after a year it goes up to $5,000. You're like, wow, I've just made $1,000 profit if I were to sell it right now. But you think it might go up more. So then the price gets to $5,000, and much like in the past when price kept trying to get, at $5,000 and it fell down back to 4K. Let's say price gets to $5,000 again, then it starts to go down. And then when it was, you could have sold it at $5,000, but now it's at $4,500. So 4,500, which we'll say is this area right here. And then it starts bouncing at 4,500. And so you look at the price, and then it bounces again at 4,500. You look at the price, and then like you check one day and it's at 4,500, and then you check the next day and it has spiked in one day back to $5,000. And then not only that, but it breaks above $5,000 and it goes to like $5,100 or $5,200. And you're like, wow, this is good. Okay, it's going up. And let's say that your goal was to wait for the watch to get to $10,000 and you'll sell it. And then price comes back down to around $5,000 where it was. And then once it hits $5,000, it starts to go up a little bit from there. And then, price kind of holds it around $5,200 and it comes back down again. And then price starts going up again at $5,000. And then it just hits $5,000 again and then just goes bam. And then in one day it goes up to like, let's just say this is like $6,000. So over the course of this time, you got into the Rolex market, and we'll call this an RM, because you knew that looking at all this data, looking at fundamental things, looking at price of Rolexes historically, you know that the Rolex market is likely to just go up over a long period of time. Whether it's like 1 year, 2 years, 5 years, 10 years, you know that more than likely the prices of Rolex watches increase over time. And so you're more prone to buy. Whereas if you're thinking long term, you're trying to make a profit, you're not going to be someone who wants to sell at $4,500 or $5,000 or $5,200 or $6,000. You're just not going to want to sell because, if you just keep on holding the watch until you're like, 20 years older, 10, 20 years older, you can get back maybe like 4 times what you paid for it, 5 times what you paid for it. Imagine having like, this watch that you could have bought new for $3,000 back in, like 2015. And then it can come all the way down like 5 years later to 2020. And the watch is now worth like $6,000. You've just doubled your money over the course of this 5-year period. And you've gotten to enjoy a pretty badass watch. Because historically, unless something insane happens, that when the market is going upwards and the Rolex market is like constantly increasing over time, that it's going to be a safe bet to try to buy low prices within the Rolex market. So the thing I want to highlight here is that to make a profit, you want to buy something at a low price and sell it at a high price. And in the Forex market, something interesting is that you're going to learn this later in the course, but you can also sell things at high prices. And then after the market goes down and it comes back up, you can enter the market on a sell. You can click a button that allows you to sell. And it essentially means that you'll profit if the market goes downwards. Okay. So just like in Forex, how, you can buy right here and then a price goes up, increases in value, and it comes lower. Then it starts going up again, and it starts going up, and then it comes down. Then you can like buy right here and the market goes up and you buy here. So just like you're going to want to buy low prices as the market's going upwards overall, if you sell high prices as the market's going down, you can capitalize off of the market going down. You can actually make money doing that. So we'll get into all that here in the next videos, which are further in the course. But I just want you to understand what a market is. I want you to understand that you have to have a direction to make any decent amount of money. If you want to make money in a bullish market, which is what it means when the market's going up, it's bullish. And when the market's going downwards, they call that a bearish market. So you can bear down, and then bulls, they like buck upwards and stuff like that. So bullish means upwards, and then bearish means a downwards trending market. To have a market where you're going to make money, you have to have a direction. That's the easiest way to make money in any market. Whether it's the Rolex watch market, whether you're selling, like cats on eBay, whether you're selling cigarettes or drugs or anything, it's easiest to make a profit when there's a clear direction. And that direction can either be upwards, and then like you'll learn in the course, that direction can also be downwards. Okay? So I've covered the basics of what markets are, what supply and demand is, and how markets work based on supply and demand, buying at low prices, selling at high prices. And the next part that I want to get into is, of all the markets you could choose to make a profit in, why Forex? Why trade Forex? I mean, honestly, there's a stock market. You could do penny stocks. You could buy and sell LaCroix sparkling water. There's so many markets you could choose to trade, and you could choose to like be involved with. You know, you could do like the used car market. You could buy like vintage cars and fix them up and sell those. What's the deal with Forex? Why trade Forex? And there's a couple things that I'm going to lay out, and I'll just keep it simple, and I'm just going to start, and I'm just going to tell you the stuff you need to know, because there's 1,000,001 things that you could know about Forex and about the background and about all these crazy super specific things. But me in this course to you, I'm only going to teach you the stuff that is absolutely necessary to know. And if it's not that necessary or not that relevant, I'm just leaving it out of this program, because if you don't need to know it, it's going to be needless complexity. It's probably going to confuse you. And beginning to learn Forex anyways in the first place is already a complicated process for a lot of people and a lot of programs. And that's why I made this program different. So that way it just keeps things as simple as possible. And I just leave out all the racket and all the trivial, stupid things that you don't need to know. So that being said, let's get into it. Why trade Forex? The first thing is something called liquidity. Okay, wow. Anyway. So what is liquidity? Now, remember in the example I gave you about you wanting to sell a Rolex watch? So if you're trying to sell a Rolex watch, you need a market to sell it in, right? So if you sell it online through one of these browsers up here, like on my screen here, if you want to sell it on eBay or Chrono24, you're going to have to usually post it up, pay a fee to post it up, make a whole post about it, make all the details, take pictures. And then you're probably going to have to wait a week, a month, maybe even longer in some cases, depending on the watch, depending on a bunch of things, depending on the price you set it at. And then you have to sell it. And then the price is going to have to go through a payment processor. And then it's going to have to go through an escrow account. And they're going to hold it until you send the person the watch. And once the person receives the watch with the tracked packaging, then the escrow will release it, and they'll release the funds to you. And this process right here, it makes things longer. It's more time consuming. And there's also extra fees and stuff. And if we were to sum this whole process up and somebody went to ask you like, hey, is there a lot of liquidity with your watch? This process, since it takes so long and it's such a pain in the ass, the answer is probably no. There's not a lot of liquidity, because liquidity is the ease at which you can buy or sell something. There's an exact definition, but I'm not going to make it complicated for you guys. Liquidity is pretty much like how easily can you buy or sell something. Versus, what if I told you that you had this Rolex watch and it was super rare and it was something like a day date presidential that one of the presidents of the United States wore, and it was that exact watch, and the watch is worth like $50,000 or more, and the moment you post that on eBay, it would be sold within like less than an hour. That would be a watch that has a lot of liquidity, because the ease in which you can buy or sell it, it's very easy. It's very liquid. And so if I were to say, hey, is that watch, is there a lot of liquidity with that watch that you have that you're selling right now? You would answer, hell yes, there is, because I could sell this in like an hour for 50 grand, no questions asked, because the market for that specific Rolex watch, like presidential, day date or whatever, it's a very liquid market. So when we get to Forex trading, if you have a market right here, and like the market's going up and you just see it's going up, and so you think, well, it wouldn't be a bad idea to buy, because I think the market's going to continue all the way up to like, well, we don't even put a price. Let's just say this is a specific price and then this is a lower price. The market started at this lower price and it was going upwards, and you just think for some reason that price is going to go all the way up to this previous area where price used to be at. And so you think that price is going to essentially make its way up there. If you were to enter a buy right here with the Forex market, it is instant. You do this through the use of a broker online, which we'll get into all that stuff later. You don't have to make it complicated right now. But essentially, the liquidity in Forex trading, like there's people all over the world trading. There's you and me who are buyers and sellers in the market. There's big banks and financial institutions and big funds that trade Forex. And since there's so many people buying and selling all at the same time throughout the world, you don't have to wait to buy or sell. It's essentially instant. Versus this shit right here, like selling a Rolex watch that's maybe just like a regular kind of vanilla watch that's not that popular. It may take you a few weeks to a few months to sell. If you're selling your car, you post it up on Craigslist or you post it on eBay or whatever. It may take you a few weeks to a few months to sell your car, and you may have to get some work done to it. It's not a very liquid thing to sell. Unless it's like a rare supercar, like maybe like a 2014 Porsche 911 GT3 priced at around $80,000 with only 20,000 miles on it. I would buy that right now for $80K. And so it just kind of depends, right? But in a sense, most cars, it's not a very liquid market. You usually have to wait like a couple weeks, or maybe like a month. It just all depends on a bunch of things. Then you got to do paperwork, you got to do title transfers, you got to take delivery of payment, all that crap. Versus Forex trading, the Forex market right here, the second you click buy or sell, your order is essentially filled instantly or within a few moments. It's usually like less than a second. And you can click buy and you will have a buy right there. And then a price goes up to here. You can click sell right there, automatically sell at that price instantly. There is 100% liquidity, high levels of liquidity. And so the reason I want to touch on this thing is the first reason of why you should trade Forex and why you are learning how to trade Forex. If you're in my course, welcome in, is because of liquidity right here. It's a very liquid market. And in my opinion, it's more liquid than stocks. Stock trading is also pretty liquid, especially like since the markets are open, like during weekdays and it's in the morning and everyone's trading. But sometimes in stocks, it can take you a while to like have an order fill. Sometimes it can take a few seconds. Sometimes there just won't be any shares of companies that you can like buy. Sometimes there won't be any shares you can sell or anyone willing to sell at a certain price. So you may have to wait like a couple seconds, to like get your order filled or something like that. But, even worse, like financial markets are a lot more liquid than like physical, tangible items anyway. But Forex market, in my opinion, is one of the most liquid because it has the most trading volume. Trillions of dollars a day flow through the Forex market. It's insane. With the stock market, I think it's a couple billion. I don't know the exact number. This is like numbers you can look up on Google, but look it up. Forex is the biggest financial market in existence. And the reason is because any country that has a currency is able to be included in the Forex market. Because essentially what you're trading is you're trading foreign exchange, which we'll get into that in a second. But essentially Forex, you want to trade because it's very liquid and it's very easy to buy and sell within the Forex market. It's essentially instant. And since it's that easy, it makes trading worlds and worlds easier because you don't have to worry about buying or selling and waiting and all this crap. So the second reason you should trade Forex and why trade Forex is risk control. Now, risk control in Forex trading essentially means that if a market's going upwards and you think that the market's going to keep going up, and so you choose to buy right there for some reason, you want to have an area of where you're controlling risk. Because what if you buy right here and you have, $1,000 in on this trade that you've put on the line? If the market goes downwards and like you buy right here and the market starts going downwards, you're going to be losing money. And we're going to get all into the details later. You're going to learn it all. But essentially, you're going to be losing money if you buy and price starts going down. Because it's just like you buying, a Rolex watch for $10,000 and you wake up the next morning and see that it's only worth $8,000 online. And then a week later, you check the price and now it's like $7,000, $6,000. You're like, what the hell did I do wrong? Like I bought it $10,000. Now it's going downwards and it's going downwards quick. So with risk control and Forex trading, you can preset levels in your trades that will automatically allow you to exit the trade without you even pressing a button. This can all be preset the moment you enter a trade, to where if you're wrong and the market goes against you the other way and you start losing money, you can select exactly how much risk you want for the trade. Like literally, you can the exact amount that you want to risk, you can do that. So let's say for this trade, you don't want to risk 1,000. Let's say you only want to risk $100. You can use a position size, which is like, you learn all about that, but how much you're risking essentially. You can choose how much you're risking, and you can also choose where you want to get out of the market at if it goes against you. And you can also automatically do something called like taking your profits. And they just typically call this a TP. We'll learn all this in the course. But essentially, when it goes up towards your target and it goes, let's say it goes in the right direction, you thought it was whoa. Thought the market was going to be going up, and so it starts going up, and then it hits the area that you wanted to take some profits at. You can automatically preset that in the moment you enter the trade right here. You can preset that in. And since you can control risk in this way in Forex trading, it means that you can, if you have, like, let's just say like 10K to trade, if you want to risk 1% of your account per trade, to where if you're wrong, you're only going to lose 1%, you can preset that in. And that would be, roughly $100, right? If you're risking 1% of 10K, you're only risking $100, 100 US dollars. And that's 1% risk of 10K, and that's great. And you know what? If you want to be even riskier, you can risk out of 10K, you can risk 5% of the account, which would be roughly $500, or it would be exactly 500 US dollars. And the pros and cons, there's a bunch of different ones, and we'll go into all that in the risk control video. However, you get to choose how much you want to risk. If you want to risk 1% of your account to grow your account, 1%, 2%, 3%, you can choose to do that right here with 1% risk. You can also choose to make this area right here, if you entered here and the market starts going down against you into negative, you can choose to set this at a $500 risk. Whereas if it were to go up above, you can make a $500 profit right here. Or if it goes even higher and you continue to hold it because you think it'll keep going up, then this right here will be like a $1,000 profit. All right, 10-year-old drawings, $1,000 profit. So you get to choose how to do all this. And the takeaway from this section is that risk control. You can control risk very well in Forex trading, because you're literally, all you're doing in Forex trading at the end of the day is you're just looking at a chart and you're just asking the question, do I think it's going to go up or down? And if I think it's going to go up, I need to put an area on the chart where I automatically get out of the trade if it starts going against me. So that way you're not risking too much. And also you want to typically have a level where you get out at in profit, because as long as you're consistently removing profits from the market, then you're going to consistently make money. They say this thing called, you'll never go broke taking profits, which there's a lot of truth to that. You want to constantly be removing profits. And you also want to be able to find a way to let winning trade runs as well, which is stuff that we'll examine in this course as well. But essentially, risk control, it's a big part of Forex trading, and Forex trading allows you to be able to control risk very well, because you can literally preset everything from the moment you enter a trade. You can do all your analysis before. You'll learn exactly like how to analyze, how to control risk, like where to get in at, where to put your stop loss and take profit at, which is like your risk areas. And you can do that very well with Forex trading. So that's the second thing. Risk control. You can trade Forex and you can control risk really well. You can set how much you're comfortable with based on what your trading goals are and all that. Another thing is the time advantage. All right. So in the middle of the chart again. So time advantage. So let me ask you this. I want you to think about this for a second. How much time do you have on a normal day-to-day basis to trade Forex? You have like an hour a day? Do you have 10 hours per day? Do you like work from home like me? You got 10 hours a day to look at charts all day? You got 24 hours a day to look at charts? Or are you someone who's really busy? Maybe you work a full-time job, and when you get home, you've got kids, you've got a wife, you got a family, or you got extracurricular activities you do, which is like sports or working out or something. So let's just say, what if you only have like 15 minutes a day? What if you only have 30 minutes a day in total? Well, Forex allows you to mold your trading system to fit your time constraints. Let me give you an example. This trade that I took right here, I took this trade yesterday. And of course, if you're new to Forex and you're looking at this chart, you're going to be like, what the hell is this? What are all these lines and these candlesticks and these little like wick things? Like what is going on over here? Well, what I'm going to do is to make it easy and simple for you. Essentially, this is a market I was trading, the New Zealand dollar versus the US dollar. And the market was going upwards. So essentially, I thought the market was going to keep going upwards. So I just chose to place a buy. Then I chose to put a risk below that area of $2,000, which is 2.5% of my account. And then I chose to place a target higher, anticipating that if the market's going to remain going up, the market should bounce upwards from where I entered the trade at, and it should go to my profit target, and I should make money. Now, I want you to guess how long it took me to analyze this whole trade. And of course, I'm just doing this for simplicity's sake right here, because this chart right here looks, you're probably not going to understand it if you're new to Forex trading. Well, this is how long it took me to analyze this trade. It took me about 30 seconds. You know what's even crazier? Is that I took another trade yesterday as well. And this trade right here took me roughly the same amount of time, 30 seconds, less than a minute for sure. It did not take more than a minute to analyze either one of these trades. And what's even crazier is I took this one yesterday too. I literally went to this chart right here. I looked, I saw the market was going downwards here on this chart. And then I went like lower right in here and saw it was rejecting this area and trying to go downwards. So I simply decided, like, you know what? I think it's perfectly logical to assume that this market's going to continue going downwards. So I took what's called a sell position, which is what we'll learn in the course. Remember I told you how you can profit if the market goes downwards? It's just the exact opposite of a buy. Whenever you buy, you're anticipating price goes up. And if price goes up, you make a profit. And if it goes downwards against you, then you lose the trade. Same thing with sells, except it's just flipped. If you sell the market at a higher price and you think the market's going down, you can enter a trade called a sell. It's a sell position, a short position. You can call it either way, sell or short position. And you can click a trade called sell, and then it will enter you into a trade. And what that means is that you can set your risk area above whatever the price is, and you set your target lower. And if the market moves downwards to your target on a sell trade, then you'll make profits if the market continues down. Exact opposite of a buy. Whenever you buy, you want price to go up, you make money. Whenever you click sell and you enter a trade on a sell, it's called a sell trade. Whenever you enter that trade on a sell, you want the market to go down. So that way you profit. This trade took me every bit of probably 30 seconds, no more than 30 seconds. All I did was I drew a line going downwards, and then I waited for the price to reject that line and start trying to go downwards. And after price started rejecting that line, I entered a trade, and my target is a little bit lower, and my stop loss is above the area, my risk area, meaning if it were to go up against me, I would lose the trade at $2,000. And everything's fine and dandy, and I was able to preset all this, so that way even if I'm asleep tonight and the market continues going lower, it can hit this area right here, which is my preset target, and it will automatically close the trade for me in about $2,000 profit, roughly 2.5% account growth if this trade wins. And the time constraint was nothing. I mean, do you have an extra 30 seconds a day for, let's just say you're looking at all the pairs I'm looking at on the chart. Your analysis could take you roughly 15 minutes in the morning and 15 minutes in the evening. And that's what the time advantage does for you in Forex trading. So if you're wondering and you're a little bit anxious and nervous that you're not going to have time to trade, that anxiety ends right here. If you have an extra 15 minutes in the morning and you can make time for 15 minutes to just get up, look at the charts, click through all of the different markets that you're analyzing. We'll learn all about this TradingView stuff and this website called TradingView where I look at charts and stuff. You'll learn all about that. But if you make 15 minutes in the morning and 15 minutes in the evening, that's all the time that you need. And that's roughly 30 minutes a day. And if you're not making time for 30 minutes a day for this, then are you really serious about creating a full-time income trading Forex? Probably not. But if you purchased this program, you knew going into this, you're going to need a little bit of time to put towards completing this course and trading every day. 30 minutes a day is nothing. And if you've got the time, probably an hour, but you don't even really need that. The way I teach how to trade, I'm going to break it all down like painstakingly step by step. So that way nothing is left out, nothing is left under the rug, nothing is left in the shade. Everything is going to be fully taught in the course comprehensively. But once you get to the end, I'm going to do a recap where I teach you, all right, here's everything you just learned. And it's going to be so simple that you're probably going to laugh and think it was so goofy that it was literally this simple this whole time. And this time effective. How do I say it? It's not time consuming. It's so time effective and it's so simple that you're going to get to the end of the course and I'm going to recap everything and you're probably going to laugh and think, wow, what the hell? This is so simple and it's been this simple this whole time. So that being said, time advantage is a huge thing. Forex trading, and you get to do that. You don't have any time constraints whenever you're doing this. So since Forex is such a big market, there's a lot of room for profit potential. If you're someone who wants to risk more, you can risk more and you can probably make more, assuming you have a good trading system and you've tested that system and everything goes good with the trading system, and you take what you've learned from me in this course. You can copy my exact trading system and you can like modify it slightly. You can tweak a few things that'll make it make sense for you, that will allow you to become consistent. And you're going to essentially take what you learn in this program about foreign exchange trading, and you are going to learn it all. So that being said, we're going to go over the last portion of this video. I'm going to cover this in just the simplest way possible, because now, since we've gotten into like why should you trade Forex, what I want you to learn now is what is Forex. And like I said, there can be so much detail on this topic right here, but I'm only going to teach you what you need to know, because teaching you that will leave out so many stupid, useless things, like I told you, like trivial things that do not matter. I'm going to leave it all out, and I'm just going to teach you what you need to know. So that being said, what is Forex? Essentially, Forex, it's just a shortened form of the word foreign exchange. And what is foreign exchange? Foreign exchange, essentially, it's just a market in which people can trade foreign exchange currencies. So let me just give you a simple example. Let's say that you travel from the United States of America and you go to the United Kingdom. So you have US dollars. Since you live in America, the currency is USD. So you have US dollars. And whenever you go to the UK, if you want to, buy things there and you want to be able to, pay for things and stuff, if you give them US dollars, some places may say, yeah, okay, we'll take US dollars. But really, like most places in another country, they're only going to accept their local currency. Otherwise, you try to hand someone US dollars in, I don't know, Mexico, they're going to be like, what's this? Like, give us pesos instead. Or maybe not Mexico. Mexico would probably be happy if you give them dollars. But essentially what you're going to do is you're going to exchange the money that you have from where you live. You're going to exchange that into the local currency, so that way you can purchase goods and services in that country. So in the simple example of you going from the USA to the United Kingdom, you're going to exchange your money into British pounds. So what is it called? GBP, the Great Britain pound sterling or whatever. So they just call it pounds. So the way to denote that is the acronym GBP, Great Britain pounds. And so whenever you get to the airport, you land in the UK and you're going to the airport and you're right outside of London, and you go to the exchange counter where it says like foreign exchange, and you say, hey, I have 100 US dollars. How much Great Britain pounds could I get? And what they're going to tell you is they're going to say, okay, well, the exchange rate right now is this, and this. And then if you give us 100 US dollars, we can give you this much in GBP. And how much you get in GBP is going to depend on the exchange rate, right? So let's just look it up right now. Like, let's just look 100 USD to GBP. So if you went there right now and you waltzed up to the foreign exchange counter at the airport outside of London and you had 100 United States dollars, they would give you $76.84. I don't know how they denote that over there, but essentially be getting just under 77 pounds. So 100 US dollars currently right now at the time of this video, December 20th, 7:30 p.m. in 2019, 100 United States dollars will get you about 77 GBP. That's the exchange rate. But it also means if you had $1,000 and you can convert it to GBP, then you could get 768 pounds. So that's that. So in another example, let's say that 1 GBP happens to equal $1.31 in US dollars, which is roughly the exchange rate right now. So if you have 131 US dollars, you can literally go to that currency exchange counter at the airport. You could trade your 131 US dollars for 100 Great Britain pounds. And here's the kicker, which is probably the most important part of you learning this right now, is that the exchange rate changes all the time. So for instance, let's say the exchange rate now is whoa. Let's say the exchange rate right now is this number right here. And let's just say that this is a variable number. It can be like 1.31. And that would be in the case of, you have 131 US dollars and then multiply by the exchange rate of 1.31 and ends up getting you 100 Great Britain pounds. And this was a 131. Sorry for my childish 10-year-old drawings here on the chart, but essentially that. The exchange rate changes. And so you can make or lose money if you exchange your money into one currency and then hold on to it for a period of time, an hour, a day, a week, a year, and then exchange it back. Chances are if you wait like a year to exchange a currency from like US dollars to Great Britain pounds and then back to US dollars, that exchange rate has probably changed to something else. So let's examine this a little bit more. Why does the exchange rate change? Why can't it just stay the same? If it stayed the same, we'd have a very stable world economy, really stable. But the exchange rate changes all the time. And the primary example is because huge companies, huge governments, huge businesses, they buy goods and they sell goods in different countries. And they have to trade huge amounts of money. For example, if a US-based company wants to outsource and buy like $1 billion worth of product from like China, let's just, because that's the most stereotypical example is made in China. A lot of the items that we sell here in the US, made in China, because it's cheaper to produce stuff over there. It's cheaper for materials, cheaper labor. People are willing to work for less. So you buy stuff from China, and let's say you're a company that wants to buy $1 billion worth of, I don't know, some sort of toy for kids in the United States or whatever. So these companies, they'll go over here with all this money and they'll say, yo, we've got $1 billion US dollars. Let's convert it into your local currency, which could be like the Chinese yuan or, whatever it is. There's like different provinces over here in China. You just exchange it into the local currency. And the fact that you're putting this much money over here into Hong Kong and you're giving them that much money, exchanging it into that currency, it literally causes the exchange rate to change. So in the instance of the GBP being a factor of 1.31, it could change to if you went to the UK and bought $1 billion worth of stuff, it could cause the exchange rate to change to 1.30. And why? Well, this is the laws of supply and demand. So for instance, if the supply here in the United States of the US dollar this is going to be super stupid and simple just so that you understand the basics. Let's just say that for some reason, the United States had 10 trillion US dollars in circulation. That is the supply of US dollars in the United States. So if there's 10 trillion US dollars in the United States, but then all of a sudden one super crazy rich company goes and spends $1 trillion, like I said, just for example, they go and they spend $1 trillion over here in China. Now all of a sudden, there is, instead of $10 trillion in the US, after this happens, there's now only $9 trillion left in the United States. And then over here in, China or whatever, this country just got richer, and the businesses within that country and all the money that's in that country, this country just got richer because now $1 trillion worth of currency has now flown over here, has now gotten to this country. And so what this is the supply of the US dollars, while it was 10 trillion, 1 trillion of it was spent and taken away. Now there's only 9 trillion. So now is the supply lower or higher than 10 trillion? It's lower. Now there's only $9 trillion. So what this causes the price of the US dollar to do is, since there's more demand for the US dollar and there's less supply, the price to get the US dollar goes up. And this is reflected in terms of the exchange rate. So let's look at a quick chart and let me show you like an actual example of this. Let's go to this chart right here. It's the British pound US dollar. What this means is that back in, see how there's like this little time thing at the bottom? Back in April 18th of 2018, the exchange rate of the Great Britain pound to the US dollar, if we look over here, it was about, like 1.43. We'll just leave it at 1.43. So what this means is that back here on, April 18th, 2018, since the exchange rate was, let's just keep it simple and say 1.44. 1.44, that was the exchange rate. And what this means is that back then, in April 2018, one Great Britain pound, 1 GBP, make sure that you know this is a 1, equaled $1.44 in US dollars. It'd be 144 USD. So now, as the market sits currently, 1 GBP equals what? Let's go to the chart and look. As it sits right now, price is like right in here. So somewhere in here, let's like draw this thing just to go to the right and see. So right here, price is around, let's just say, because this was yesterday, it would have been around 1.31. Okay, so we'll just say, we'll round it off. Price is somewhere right in here. Let's just say, just to keep things simple, it's about 1.31. So now 1 GBP in today's market equals $1.31. And so what that means is it means that the Great Britain pound has lost value, because 1 Great Britain pound could have gotten you $1.44 USD back then, but now that same 1 GBP is now only worth $1.31. Use the US dollar. So 1 US dollar and then 31 US cents. And so if you would have had 1 Great Britain pound back there in 2018, up here, and just you'd held on to it from April of 2018 all the way to now, a year and a half later, December of 2019, you would have lost money. So let's look at another example. What if earlier this year you had bought Great Britain pound down in here, and let's just say that, just to keep it simple, it's around 120. So let's just say that 1 GBP equals 120 USD whenever you bought at that time, and we know now that 1 GBP equals, what is it now, 131. So this is GBP, we'll just put G there, and this is USD. So now if you would have bought back there, let's just make sure that, what is that time frame, like down in here at this price down in here, if you had bought the Great Britain pound against the US dollar, meaning like, you're looking at it relative to the US dollar, it was at a factor of 1.2 down here. So 1 Great Britain pound would have gotten you $1.20 USD. But if you had just had that 1 Great Britain pound and you'd held it until now, you could have made, what is this, 11 cents? You know what gets even crazier is that what if you had gotten 10 Great Britain pounds? Well, 10 Great Britain pounds, if you just move the decimal one over, that would have given you $12 roughly. And then now, if you still have that 10 Great Britain pounds that you would have got earlier this year, held onto it, well, now it's given you $13.10, because pretty much the decimal just goes over if you've got extra there. So 10 Great Britain pounds would have gotten you 12 US dollars a couple months ago, back in August. So about, what was that, about 6 months ago or so. And now 10 Great Britain pounds gets you a little bit more than that, 13 US dollars. So you've made like a $1.01 profit. So what's crazy is, what if we did this with a lot bigger numbers? What if instead of 10, we did it with like 100? I'm going to use the calculator on my phone because I don't want to screw anything up, having to keep all my thoughts together to do these videos and everything. Let's do like 100,000. Let's say you got 100,000 GBP, so 100K, and that at the time would equal essentially the same thing, right? Like it's just by the same factor. So 100,000 GBP would have gotten you 120,000 US dollars. And then just to keep things simple, now you still have 100,000 GBP, but instead of 120,000 US dollars, it gives you 130,000 US dollars. You've now made a $10,000 profit. And all you would have done is you just would have changed your US dollars to GBP right here, held onto it until the exchange rate changed, And if you thought that the GBP was going to go up for some reason, the exchange rate was going to go up, then you could have profited off of that knowledge. And you could have had a preset risk, and you could have had a preset, target of what you wanted price to go to, and it was automatically going to like send you off into a profit after that. You can preset all of this stuff. And it's crazy, and it's very good if you can like predict all this stuff, which is what you're going to learn all about in this course. But essentially, the takeaway is that this thing right here, the exchange rate changes, and you can profit off of this. And what's even crazier is it's as simple as having your phone, and you can download an app, which I'm going to teach you which app you need to download and stuff. You can have this app on your phone, or you can look at your computer screen, and you can do it from your computer. So either from your phone, put that there, phone or a computer, you can just click a button. If you think that price is going to go up, you can click a button, and you can like put in where you want your risk, and you can put in where you want like the market to close you out and profit at. And you can do this all from your phone without having to physically go and exchange all these currencies and do all this wild stuff, because it's not very practical, right? To go and like to the airport and then exchange your currency to like 100,000 GBP, hold on to it for months and months. You can just do this through the use of a broker online, which is like an intermediary between you and the market. And then with the broker, you can use your phone, look at a chart, place a trade, and you can use what's called leverage, which is leveraging your current money, meaning you don't have to have $100,000 to trade. You can start with as little as like $10,000, $5,000, $1,000, $100, and even lower. Some brokers will let you start an account with $10, though let's just be real. You're probably not going to make any significant amount of money with $10. $100, maybe you could. 1,000, yes, 5,000, 10,000, it's all good. But so you want to start with a reasonable amount of money, but there's not this huge overhead entry cost. It doesn't cost, you don't have to have 100,000, or $1 million to get started in Forex trading, since you can just use leverage. And leverage just essentially means that you can use the broker's buying power to buy more currency. So in that case, if we were using this example here of you obtaining 100,000 Great Britain pounds and then holding on to it for those months and then exchanging it back and making an $11,000 profit, or whatever it is, $10,000, $11,000 profit. You could do all that through the use of leverage without even having to have access to 100,000. You can maybe have only like, 10,000 or $5,000 in your account, but you can just use the broker's leverage in order to take bigger trading positions. As long as you're still controlling risk, where your risk is at, exactly how much you're risking per trade, then you can use broker's leverage to allow you to trade larger position sizes and make a significant amount more money if you know what you're doing and after you've practiced a system that works really well when it comes to trading. So that being said, when you're trading Forex, you're essentially buying and selling a currency at the same time, because whenever you trade Forex, just like you see right here in this example, GBP USD, you might be wondering like, why is this together? And why are pairs like this up here, like the New Zealand dollar USD? Why is it together in this one pair? Well, to trade Forex, like when you're trading margin online, you have to trade the value of one currency pair against another. So for instance, if you're trading the value of the euro is going to fluctuate in value. It's going to go up or down. But how do we track this? Like, what do we trade it against? You have to trade it against the value of another currency. So these, sometimes what they call them is they call like the first one, they call this like the base currency, and they call this like the quote currency or something like that. They can call it that. You don't need to know all that. Just understand that Forex, when you're trading Forex, you're trading them in currency pairs. And that's what all these little things that you're going to trade in Forex, all these are called, they're just called currency pairs. They're just pairs of currencies. And then you just trade the value of these two pairs against each other. And there's a little thing called the exchange rate, which it goes up and then it goes down and it changes back and forth. Your idea of what you're really doing is you're just looking at a chart, and then you're deciding which way you think it's going to go. And if you think it's going up, you're going to buy, have a risk below and a target above. If it goes up, you make profit. And then it might get to a certain area where you think it's going to start going down. If you think it's going to go down, you're simply going to click sell. You're going to enter the trade in a sell, have your risk above and your target lower, and you can make profit off of the market going down. So this little exchange rate right here, historically, will be represented on the price chart, because you can see like back in 2018, the market exchange rate was right here, and then it went up over the course of the beginning of 2019, and then 10-year-old drawing. And then now it's the end of 2019. It's about to be 2020, and the exchange rate is down here. So you can see like historically what price is done in the chart and make a trading decision as to what you think the exchange rate is likely to do in the future. And then you can enter trades for these pairs. And you can, like I said, you can do this all online through the use of a broker, and you can use leverage to sort of leverage your money to trade more and create more profits. You can also lose more money that way too. But like I said, if you know what you're doing and you have a good trading system, then it's okay to use leverage, because if you know you're going to make a profit anyway, or if you know you're 99% likely to make a profit over the course of a 3-month period, 6-month period, then using leverage is fine. So essentially what you've just learned is that Forex trading, in short, is just foreign exchange currency trading. You're trading the value of one currency against another. What you're trying to do is you're buying a currency and then letting the exchange rate change and then selling that currency at a different exchange rate. And all this boils down to is you're just looking at a chart, asking yourself, do I think it's going to go up or down? If you think it's going to go up, you're just going to buy. You're going to put a risk below and a target higher. And if it goes up and it hits your target, then you make money. If you're wrong and instead it ends up going downwards, it'll hit what's called your stop loss. You'll lose the trade and you'll lose money. The idea is to just be right a little bit more often than you're wrong. And even if you have just like a 60, 70% win rate, you're going to be profitable trading. And it's truly just that simple. So you're looking at a chart, trying to decide whether or not it's going to go up or down. You're going to buy if you think the market's going to go up, and you're going to have your preset risk. And then if you think the market's going to go down, then you can enter a trade called a sell. You can sell the market. And then once you enter the market on that sell position, on that sell trade, if the market goes down, then you'll make a profit. It's that simple. So that being said, in this video, what we've covered is we covered what a market is. We've also discussed why should you trade Forex? What's the big deal with the Forex market? And also we've covered what is Forex in the simplest way possible. There's a lot more stuff I could teach you guys about all this stuff, but all that stuff is sort of, you just don't need to know it. It's just, it would create a lot more like stuff in your brain. You'd probably be taking a bunch more notes, writing it all down, and it's just so trivial and unnecessary. You just don't need to know it. The stuff that I've taught you is all you really need to know about an introduction to Forex trading. Okay, so I hope you learned something new. I hope you got a little bit more knowledge, even if you've already, been trading Forex for a while and you just hopped in this course to kind of look at my personal take on it or to expand your knowledge. I hope you learned a little bit more about the markets, what a market is, supply and demand, those types of theories and stuff like that, and sort of my take on what Forex trading is. So that being said, let's jump right into the next video. I'll see you guys there. Cheers.